Three letters can bankrupt a country. Did you know that in May 25, Moody's downgraded the United States AAA credit rating, marking the loss of its last AAA rating from a major agency? This isn't just financial jargon. It could affect everything from your mortgage rates to your retirement savings. In this video, we'll break down what credit ratings really mean, why they matter to everyday people, and how the US went from being the gold standard of financial safety to losing its top tier status. Let's start by imagining that your neighbour needs some cash, and you decided to lend them the money, in which they have promised to pay back next month, with interest. How do you decide if they're trustworthy or not? Will they repay you? Investors face this challenge on a massive scale, trying to figure out which companies or governments will repay their debt. Without reliable information, lending money is like guessing, and wrong guesses can cost billions. This problem led to credit ratings in the early 20th century, starting with Moody's rating railroad bonds in 1909. Bank regulators needed a way to spot risky investments after too many defaults, so they required bonds to carry standardized ratings. These ratings were a set of characters, which reflect the likelihood that the borrower would pay back their debt, and a way to understand how risky the investment is. During the housing bubble in 2008, many mortgage-backed securities got AAA ratings they didn't deserve. When homeowners defaulted, these safe investments collapsed, triggering a global recession. That crisis proved how vital accurate ratings are for preventing financial disasters. Today's rating agencies have learned from those mistakes, using stricter standards to evaluate debt. Modern credit ratings require analysts to review a borrower's income, debts, economic conditions, and repayment history. For the US, Moody's cited a $36 trillion debt, rising interest rate costs of nearly $950 billion in 2025, and persistent deficits as a reason for the downgrade. Ratings assign letter grades to predict default risk. Higher grades mean safer bet. A company with a single A rating might pay 5% interest on a loan, while a B-rated one pays 7%. That 2% difference reflects the extra risk investors take. Ratings help investors allocate money efficiently. Pension funds tend to stick to higher rated bonds, while hedge funds might chase riskier ones. Without this system, comparing investments across countries or industries would be nearly impossible. Next, we'll decode what those letter grades mean, and how small changes can have a big financial consequence. Those letter grades, like AAA or BB, might seem confusing, but they follow a clear system showing how likely an investment is to fail. We are going to focus on the two largest rating agencies, Moody's and S&P Global, who have two slightly different rating systems. In our example, the company Phantom Incorporated has been assigned the highest rating, AAA. It is therefore the safest investment, with around only 0.02% of AAA rated corporate bonds defaulting within 5 years. Analysts give this grade when a borrower's financials show almost no risk. The scale drops from there. AA ratings are higher quality but slightly riskier, and a higher likelihood of defaulting on its debt obligation. Single A ratings are solid but more vulnerable to economic shift. As you continue down this rating scale, the likelihood of the corporate defaulting increases, raising the likelihood that an investor will lose their investment. When the chances of defaulting increases, the interest rate charged to the borrower tends to also increase. Let's next explore how ratings apply to countries, and why America's downgrade matters. Credit ratings do more than assess risk. They shape global economic stability. The US downgrade means higher borrowing costs, with the 10-year Treasury yields hitting around 4.5% and mortgage rates climbing above 7%. This affects everything from home loans to retirement funds holding bonds. Despite the downgrade, Moody's notes the US retains strengths like the dollar reserve currency status and a robust economy, which limits immediate impact. Still, a single rating change can cost governments millions more in interest, or limit capital access for riskier countries. Now that you know the rating scale from AAA to D, you can interpret financial news better. Try looking up your own country's credit rating. It reveals a lot about its economic health. The next time ratings hit the headlines, you'll know exactly what's at stake.